Considering how debt helps the wealthy accumulate wealth more quickly. You know, there are both good and bad debts in the world of finance. Bad debt is when you owe money on items that have fixed payments but depreciate. Owning an asset with debt that increases in value or generates positive cash flow over and above the loan payment and costs is referred to as having good debt. All debt carries risk, yet some debts are paid for while others are purchased outright. Hello everyone, welcome back to my channel. Today's video will feature 5 ways the rich make money from debt. But first, if you haven't already, please subscribe to my channel and enable the notification bell so you can see more interesting videos like this. Many individuals are terrified of the term debt. There are several books, periodicals, and television programs that focus on educating viewers on how to manage their debt. While taking on debt may seem like a bad idea, done well, it may have good effects. Leveraging debt to enhance your earnings tenfold is the main way to use debt for investing well. What precisely is leverage? Leverage is the process of increasing your return on investment by leveraging borrowed funds. With leverage, you can generate returns you previously thought unattainable, but at a higher risk of capital loss. In today's video, we will discuss 5 ways debt and leverage can increase your wealth. How can debt make you wealthy? When you utilize other people's money to manage assets that increase in value and provide cash flow that increases your net worth, debt may make you wealthy. Leverage is created by good debt. For a tiny monthly cost, you may manage an asset with a much higher value. Your gain is based on the asset you hold, not on the amount you were paid. For the owner to have access to funds throughout the first phases of creating and managing a firm, many enterprises begin with business loans. The business owner owns the actual business as well as the value of the future earnings and cash flow, whereas the lender has the right to the interest on the loan and the payments. Debt provides people with the capital they require to produce valuable assets. All people may become entrepreneurs using debt and credit. So, how do wealthy people benefit from debt? By taking out low-interest loans and gaining more control over assets, wealthy individuals use debt to increase returns on their investments. Their assets and money are only utilized to get loans with a sufficient credit line for use in business and investment. While their borrowed money is working to generate returns and increase their net worth, their assets may be producing returns as well. Key lessons. Despite being generally seen as a bad strategy, using debt effectively can have good effects. Debt can be used as leverage to increase an investment's profits, but it also increases the possibility of bigger losses. To borrow stock to sell it for more money than it is worth, investors use margin investing, exchange-traded funds, ETFs. With leverage, enable investment in a fund that makes use of leverage to follow an index. Although many hedge funds employ leverage, they are frequently only accessible to wealthy people. Borrowing stocks for short selling involves anticipating a decline in borrowed security. Number 1. Margin investing. By using margin, you can purchase more shares of stock than you have available cash. You might leverage your investments and create a margin account. For instance, if you have $50,000 in your conventional brokerage account, you can deposit up to 50% of the stock's purchase price into a margin account. You would have $50,000 in cash on hand, and your broker would loan you an extra $50,000. You can now buy things worth $100,000 with your $50,000 investment. You could buy shares worth $100,000 with this money. You can pay off the debt and keep the profit if the stock price rises. The drawback is that your brokerage business may issue a margin call if the equity in your account drops below a specific amount. Your broker may sell your whole stake in a stock and incur losses if you are unable to fulfill your margin call due to a lack of money. Number 2. ETFs with leverage. By going long or short on a certain index, investors and traders can increase their returns by using leveraged exchange-traded funds, ETFs. Leveraged ETFs from fund firms like ProShares allows investors to increase gains and losses by 200% to 300%. You can invest in certain indices, bonds, commodities, or businesses using these funds. The tremendous profit potential makes leveraged ETFs appealing. Leveraged ETFs can help you generate returns that most investors only dream about during market booms. Leveraged ETFs may operate against you in the same manner that they can work for you, which is a concern. Leveraged ETFs can multiply losses by wiping out your whole investment in a matter of days, so long as you are not an expert trader in and out of these funds. Number 3. Hedging funds. Some of the greatest consumers of leverage are hedge funds. They are renowned for exploiting leverage to produce atypical results. Many hedge funds use leverage that might reach 10 times their entire assets. Leverage has been employed by multi-billionaire hedge fund managers like John Paulson to transform accredited investors become multimillionaires. A hedge fund might go out of business and lose the money of all investors if the fund manager's investment thesis is incorrect. Hedge firms with bailout needs, like Long-Term Capital Management, LTCM, had the leverage of up to 30 times their assets. Number 4. Short sales. The typical sequence of first buying, then selling stocks is reversed when shorting stocks. Selling short is the act of selling something that is not yours. You borrow the stock from your broker and sell it to a buyer when you sell a stock short. The shares are then your broker's to pay. You get money from the sale, but you have to use it to buy shares later to reimburse your broker for the share loan. In a short side transaction, you are long capital and short the shares. Using the credit that's available in your margin account, you're in debt for shares. Your broker can refund the shares to the account they were borrowed from after you buy to cover the short position, resulting in your debit purchase to buy back the shares you were short in the open market. These days, everything is mechanized and done electronically. A short seller reverses the trade flow by first selling and then buying back. Using debt, you may make money if you sell something short for more than you'll have to pay to buy it back later. You will also need to pay margin interest on the size of the position kept if you are short a stock. Any dividends payable on the stock during the time you are short must also be paid. This is how investors may profit when the stock market moves in both ways, up and down. Number 5. Leverage in real estate. You may leverage your capital by multiples of 20 when you buy real estate with 5% down payments or monthly payments. An investor in real estate may put down $10,000 and make monthly payments of $2,000 to buy a $200,000 house. Real estate investors get profits on the entire bank loan, not just the initial investment. The $10,000 down payment generates a 300% return with the $40,000 invested capital if the real estate increases in value from $200,000 to $240,000. To produce cash-flowing assets for monthly revenue through leverage, debt can also be utilized to establish monthly rental homes or homes that can be used as Airbnbs. The cash flow returns are based not on the invested capital in the property, but rather on the total amount of debt. After saying all of this, the video for today is at an end. If you enjoyed this video, don't forget to hit like, the subscription button, and the notification bell to get notified when new videos are uploaded from our channel. Do well to share your thoughts in the comment section. See you in the following video.